Ladies and gentlemen, good day and welcome to the CSB Bank Q2 FY23 results conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manish Shukla from Axis Capital. Thank you, and over to you, sir.
Thank you, Kathy. Good evening, everyone. On behalf of Axis Capital, I welcome you all to this call. From the management team, we have with us Mr. Prabhay Mondal, MD and CEO, and Mr. B.K. Divakara, CFO, and other colleagues from the management team. I would request Mr. Mondal to make a few opening remarks, and after that, we can open the floor for Q&A. With that, over to you, Mr. Mondal.
Thank you, Manish, and thank you everybody for joining the Q2 earnings call for FY23. I wish to start with wishing a very, very happy Diwali to everybody and their family in advance. Coming to our bank results, I would like to just talk a little bit briefly about what's happening, what kind of an environment we are in, both globally and in India, and then straight get into specifics of our results, and also give a little bit of a brief of what our medium-term and long-term vision is, because more than a quarter result, I think for our bank, the key story is about what we want to do in the medium and long term. So starting on the global side, we all know that we are going through post-COVID, a very different kind of a challenge with global growth being anemic, with all the all kinds of issues there. Interest rates are just skyrocketing. Inflation is skyrocketing, whether it is in US, whether it is in Europe. The US 10-year yield has crossed 4%, 2%. At a 2-year yield has skyrocketed yesterday. Also seeing US dollar index is volatile but very, very high. Indian rupee has also now crossed 83, which is a concern. It also issues on CAD and things like that. So I think we are passing through a fairly volatile, uncertain kind of a situation globally. And while India is relatively in a better place to be in and more stable, but we cannot be completely away from some of the global challenges. And that is shown once the FOMC raises the interest rates, which again is expected to be anywhere between 75 to 100 basis points, and they constantly keep on raising the bar in terms of where they can go. RBI also to some extent has to follow suit. Though our inflation, I think RBI has already said that just sort of peaked, and various NPC commentary has been showing that things are sort of stabilizing on a higher base. I think growth is coming back. I see that the banking credit growth this quarter should be somewhere around 18 to 19%. And as RBI governor has already said, that going forward monetary policy will remain watchful, stability while supporting growth. Having said that, India is always have a challenge of this oil price, and oil price is right now stable, but there are various OPEC announcements pending. The U.S. Oil reserves are expected to, be not so high at this point of time. So we have to wait and watch how the oil price and impacts comes. We had significant outflow from the country in terms of FII. It came back, and again, this month outflow has also been slightly high. So to that extent, I think we have this volatility, and in this volatility, I think the banking ecosystem has done extremely well for us as a country, and more results are coming. I'm seeing that broadly this has been a good quarter for most of the companies, and hence we remain very, very positive and hopeful that we are in a good place at this point of time. With this macro, I will just get into CSB specifics. You probably have already got the numbers, but I'll go through them, the key numbers a little bit. So we had a significant improvement in net profits, 31% year-on-year. But and Mr. Devakar will explain later on as and when those questions comes up on our operating profits and things like that. There are certain factors which kept our operating profit little muted. For the quarter ended, net profit is 5% higher than last quarter at 120 crores. Provisioning buffer of around 200 crores over and above the regulatory requirements. Because we take accelerated provision, we also have COVID provision, which we call it, 106 crores. We could maintain again a NIM about 5% on a yearly basis, 5.6% and 5.38% on a yearly basis, and quarterly basis 5.6%. So last quarter was one of the highest NIM for us at 5.6%. But I'll come back to this, that obviously this is not sustainable. ROE improved from 1.53 in H122 to 1.81 in H123, while sequentially we improved from 1.75 to 1.87. So broadly, we are in line with what I keep talking, that will be between 1.5 to 1.8. We are in that range. Liability growth is gradually coming back. So CASA growth was 16%. Overall growth was deposits was little more than 10%. Cost of deposits reduced from 4.39% in H1 FY22 to 4.14 in FY23. Though gradually we are seeing that this will start picking up now, which will impact to some extent the NIM over a period of time. Net advances growth has been positive. It has been 24% YOY and 8% QOQ, and this is one of the things which I've been telling everybody, that we will focus on growth and quality growth while we keep a sharp razor focus on our credit quality. Year-on-year 24 and QOQ 8% says that we are being consistent in terms of what we are promising, that we will continue to try and grow faster than the system. Gold portfolio registered growth of 47%, and yield on advances was at 10.7%. On the asset quality side, things improved further. So GNPA was 1.65%, NNPA 0.57%, PCR 90%. PCR, this of course includes the write-off. So if you take that out, it will be marginally below 70. Contingency provisions accounted in the books is higher than NNPA. Continuing with the accelerated NPA provisioning, as I said before. Robust capital base. There are very few banks who has a capital base of more than 25% and ROE more than 18%. So this of course is possible to a great extent because of our large size of the gold loan portfolio, and this again is not sustainable as we grow the mix of other businesses over a period of time. Shareholder value creation from that perspective, book value per share has reached 158, EPS 27.1, ROE of 18.49, which I just mentioned before. And we continue to open our branches. So this year also we open 100 branches, 81 locations already approved, work in progress. We are confident of opening 100 more branches this year, and we will continue to grow at least by 100 branches every year, if not more. And there's a significant investment planned, and the execution has started in a big way on technology, whether it is LOS, core system migration processes, thinking, LMS, the entire surround system. So we are thinking significant investment into the technology stack. So those are for the numbers. Slightly on the midterm to long term, what we are planning. Again, I don't think the commentary is changing, and I hope it doesn't change in the next 3 to 4 years, because one thing what I've learned in banking is be consistent and ensure that we deliver every quarter what we promise. So we continue to invest. So as per our SBS strategies, sustain, build and scale 2030 vision, we have clear vision where we want to reach, how we will reach there in 2030. We want to have a sustained growth. I said that before, that in the next 3 years CAGR of 25%, give and take a little bit here and there. And post that, higher growth, hopefully. That time we should have all our technology stack, credit processes, entire collections ecosystem, which helps us in building our retail businesses, the payments ecosystem, the SME, and also we are starting to invest into a little bit of transaction banking, both in terms of leadership, processes, technology, everything. So by 2024, FY24, we should be ready with all that. And then next 2-3 years, we will start building those businesses. And last 3 years of this decade, which is SBS 2030, we should have a hockey stick approach in terms of retail growth and SME growth. So because by that time we'll have everything ready, technology, distribution, leadership, processes, and then it's a multiplier effect because one leads to the other, as we all know what happens in a banking ecosystem. So we are looking for that hockey stick somewhere between 27 and 30. And hence, directionally, while our cost to income, where it is today, I've always said that it will be between 55 to 60. And I don't mind it taking closer to 60, provided most of those are happening because of investments and not because of cost. Cost will be managed through productivity. Investments will be managed through payback period of those investments. And if we do the right eyes in the cost to income, in cost, I means investment, not income, right investments, then we hope that by end of this decade, we should be able to bring the cost to income below 45%. So that's the thought. We'll also ensure that the business mix is more balanced. So again, exit 2030, we should have highest portion of the book should be retail, more than 30%. And then between gold, SME and wholesale, the rest will be shared equally or little with 1 or 2-3% here and there. So that's the thought process. But right now, as you see that, as I said before, that gold proportion is only going up, and it can go up to 45% before we start rationalizing. But it will not go beyond 45% because we also need the income to. The other important thing is we will continue to focus on other income to non-interest income to total income, where our proportion is very low, and we want to take it up. And this year there's a specific, this quarter there's a specific reason why it's low, because if you take out the year-on-year PSL's income, which is a special income, and the treasury income, which is negative this quarter, for various reasons, including SR and including some of the other reasons, treasury bills and things like that, we book some losses strategically. Our actual core non-interest income actually has grown by 48%, I think. So which is, and that is a mission, right? That will continue to grow because as we add more products, more transaction banking products, retail products, payment products, third-party businesses, more customers coming into the system, and customer acquisition is going to be one of our key focus areas. Then we expect our ability to grow the core non-interest income to the total income. And then even if we have our, which will happen, even if our NIM comes down, which will happen, our ROE will sustain between 1.5 to 1.8%, primarily because of some of this fee income that will continue to grow. And that is typically how the market operates. So we cannot be an outlier. As we grow, we have to be part of the system. So we'll continue to grow. The other important focus, and this is my last statement before I open it up for questions and Mr. Devakar's comments, if any, is can only happen provided it is quality growth. It is, and I don't see a challenge at all in the asset growth. So we have to fund it. So we have to have a significant focus on liability, whether it is CASA, whether it is actually its customers. And along with that, FDs, general FDs, everything will come. We'll create focus structures on task, which is trust, associations, etc. We obviously do not want to depend too much on wholesale deposits. though we are giving targets to our SME and wholesale team to also be as self-funded as possible. But liability, quality liability and customer acquisition and customer franchise is key, because even when we tomorrow have the assets, products ready and we have the processes ready, we need a significant base to cross-sell this to. And also today we need to ensure that to retain our LCR and to sustain to support a sustainable growth of faster than the system, we need a sustainable liability franchise, and hence a lot of our focus is going into building the approach towards liability and how do we talk to customers and get those deposits. In conclusion, I'll say that we are very bullish about how we want to grow. We will be consistent. Hopefully there will be no surprises and shocks. When you look at the NPA slippages, again a word on the credit cost, it looks negative, but obviously negative credit cost is technically too good to be true. So obviously we will have some credit costs eventually coming in as slippages as we grow. But we will continue to have our gross and net NPA below 2 and below 1% over a period of time. And this quarter has been a testimony to that we can hold on to a good performance on that and make it even better. So with that remarks, I would like to hand it back to, in case Mr. Devakara has any comments. Otherwise, we'll hand it back to for questions from all of you. Thank you very much.
No, you have covered, Pralay. I don't think anything needs to be supplemented. But during the course of question answer session, if something needs to be supplemented, I will do that.
Sure. Thank you. So let's get into Q&A then.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening.
Good evening.
Yeah, hi. And congratulations on a good set of numbers. So firstly, my question was on the PSLC market. So what exactly is going on? You mentioned in your comments about draining of opportunities. So what exactly is happening there that's lowering the PSLC income for us?
So it's very simple, Mona, that we had booked PSLC income last year by now, but this year what you have seen is that the pricing is not attractive right now to sell the PSLC, but pricing is very attractive to buy anything which we need for micro and things like that. So we have just done the reverse. So we have bought what we needed to for the year, hopefully, and we have not sold anything because we think by Q3, Q4 we will get a better price. So that's earning which we expect to come, and that's a buffer which we are holding at this point of time. At the same time, I think last year, Mr. Devakara can confirm, I think we are around 34 or 35 crores. 33.4 crores. Yeah. So that is something which we have not yet booked this year because the pricing is not attractive right now, but we have the pool which we can use.
But as I understand, in Q3 and Q4, the pricing anyways becomes less attractive. So is it fair to say that the full year profits from PSLC book could be lower than what we've been seeing?
The cycles are different now. Either everybody is done very well on PSL suddenly, or so we can only know in the Q3 and Q4 what the story is. But we believe that we should be able to get better pricing in Q3 and Q4. It's a call which we have taken.
Sure. And coming to the gold book, so we have seen very strong growth. much higher than what we're seeing for, say, other banks and even mainstream NBFCs. So, what really is helping such growth trends? And if you could give some sense on how much of these could be balance transfers from other entities, especially NBFCs, that help?
Sure. So, our segment of customers is slightly different to the NBFC segment of customers. Like, as I said before, that the bigger banks work in a different segment and in a different yields kind of our yields are different, our segments are different, and basis, obviously there will be always a 20% overlap and things like that. So, not too much. I know why you're asking this question, because there is a lot of noise on this right now. But frankly speaking, two things are happening in our portfolio. Our tonnage is increasing because prices have not really been very, very volatile. It has remained similar kind of a price. So obviously tonnage has improved to that extent, and a lot of existing customers are brought in new tonnage to the bank, as well as we've added a lot more customers. So it's a function of execution what we have done well, and this gives us the confidence that the branches are getting ready. Tomorrow you will see that even liability, the branches are able to execute better. So question is, if somebody can execute better the gold, they can execute better the liability, and tomorrow when we have the assets or SME or whatever else, they should be able to execute better. I think we are able to get better productivity out of branches right now because of execution focus, monitoring, leadership, on ground, excitements and things like that. That is what is helping us. So I think it's business as usual point of time. And our portfolio is small. I mean, percentages don't say everything. So our portfolio is small. So even if you focus on it and do a little better, the growth automatically comes. But we are ensuring that we are not depending on this growth. So I have told very clearly, because with this quarter we want to grow slightly better on SME, a little more on wholesale side. And retail will take time, because retail is a high road. It will take some time, and we don't want to depend on gold so much at this point of time. So I think that gold will be steady. Don't expect that. There's a lot of disturbance on the line. I don't know why.
So there was an audio leak from your line. Could you repeat the last?
Is it?
Yes. Now we can hear you.
Okay.
Follow-up question on this. So, on gold side again, with growth trends getting better across segments, the general credit environment getting better, do you see the competitive environment in this space get 2-3 years?
When you say better, what does it mean?
In the sense that pricing is less competitive.
Yeah. So it is bound to happen, because once the liquidity has dried up in the ecosystem and cost of funding starting to go up, so some of the NBFCs, some of the banks, etc., will, easy liquidity is not there anymore. So pricing will have the right pricing for the right risk and right operating cost will be put in place. So I think that eventually, whether it is SME, whether it is gold loan, I think even to some extent the mid market where we operate on the wholesale side, we are seeing pricing rationality coming back.
Sure. And just finally, on the SME book again, despite a small base, we are not seeing, and a focus area for you, we are somewhere not seeing growth coming. So what is the outlook there? You just mentioned we are seeing growth from this quarter or so, but what sort of growth trends could we build in, or what sort of disbursements are we seeing in the last few quarters, even if there are some runoff? Yeah.
So what happens is, when I know this, that both our retail and SME has a large component of an old book, okay? And so some of them we are allowing to run, some of them naturally runs off, the term loans and on the...
Excuse me, this is the operator. Sorry, connected.
Hear us?
Yeah, we can hear you now, sir.
Yeah, I don't know what is happening. So what I'm saying is, so we have significantly enhanced our, credit governance on the SME side as well as the wholesale side. We said that we want to do risk-based pricing. We want to ensure that we do businesses at certain ratings and things like that. So we always had those policies, but we have implemented with little more iron hands because we want a sustainable growth. So to that extent, some of the businesses which are running off, we are happy. But the new businesses which we are building is also very good quality. Our ratings, our rating-based pricing, all of that is falling in place. So we are putting a lot more science behind it. And hence, I would see that the second half of the year, we have done all that corrections in the portfolio in the last 6 months. I think the second half of the year, we will see a growth in the SME portfolio.
Ma'am, you're done with your question?
Yeah, I was just asking which should be in line with the rest of the book, the second half growth in SME.
Yeah, I think SME should be having the growth in line with our bank growth, second half.
Sure. Thank you, sir. That was very helpful.
Thank you.
Thank you.
A reminder to all the participants to ask a question. You may please press star and 1. The next question is from the line of Pritul Shah from Anubhuti Advisors. Please go ahead.
Yeah, thank you for the opportunity. My question is with respect to the overall industry growth. Like if we see that large banks and small banks all are giving decent growth in decent advances growth, but now that the interest cycle is going up, what is your understanding on credit growth going forward? And normally, how much time it takes to impact the economy? Like, what is the lag in impacting the credit growth because of this interest upcycle?
I am not sure I understood the question fully, but let me try. Credit growth is a function of various things, including the customer confidence, the salary growth. If you see some of the numbers on the savings on the consumer side, it has actually come down a little bit. The debt to GDP has actually gone up. So if you look at some of these numbers, people are having the confidence somewhere, and there's a little bit of a pent-up demand as well because of COVID and some of the other stuff. There has been a muted demand both on retail and SME in the last few years. And wholesale has been absolutely muted and still investments has not come back, capex has not yet come back and things like that. Project finance, etc. are starting a little bit here and there. But generally the feel is that everybody is seeing that there is a growth picking up almost everywhere. I mean, the private investment should start coming in, the capex should start picking up. So I think generally the view is that a credit growth upwards of 15%. Because it's typically India has always done credit growth more than the nominal GDP. And today, even if you have a nominal GDP, if you have a credit growth higher than nominal GDP, you have to be somewhere around 15%. So given that perspective, I think we see a minimum of 15% growth, credit growth going ahead. And we are saying, and yes, interest cycle, sometimes what happens is the other way around, that interest cycle starts going up. It impacts the credit growth because sometimes the ability to repay or ability to consume is little lesser in the customers because there is lesser money in the customer hands to pay EMIs and things like that. So, and also with liquidity, which is not abundant right now, banks also has to be careful in terms of how they build the liability balance sheet and how they fund the credit growth. So it is going to be interesting to see how it works. But good part about all this is that there is a rationalization of pricing, and the classical banking practices are coming back between NBFCs, banks, SFBs, etc. because in between there was a scenario where the interest rates are so low that sometimes it was below savings rate also, some of the rates. So now I think the classical banking is coming back, and hence I think a normal credit growth is expected. I'm quite confident unless there is a significant global headwind, which is possible because we are not completely shielded from that. We should be able to see a reasonable credit growth in our industry. And we as a bank, we are not, because we are not such a large part of the ecosystem, our growth is so much more dependent on what we execute. So our credit growth may or may not be so much dependent on what is happening in the ecosystem. Ours is more execution, product, processes, building scale, building distribution. So we are more confident of the kind of credit growth which we'll bring in.
Okay, got it. And my next question is with respect to the increase in NIM. So YOY, if we see that our advances has grown up by 24%, and absolute NIM is up by 17%, despite NIM percentage increasing from 5.22% to 5.6% in this quarter. So can you explain why this difference is there? Like advances are up by 24% and NIM is up by 17%.
Yeah, let me try this, but this is a more technical question. Mr. Devakara will answer better, but let me see if I know a little bit. So I think it's also see that our CD ratio has gone up to 87%, and our CD ratio is significantly lower than this, and this is a story of the industry. Also, our investment book, has rationalized a lot more, and hence on an overall basis, the NIM looks better at this point of time. Mr. Devakara, you want to respond to this?
Yeah, it will not grow in proportion to the growth in advances. So beyond a point, we may not be able to increase the pricing. So it has to be at a certain level. So from 5.17 to 5.60, so it is in line with what we had expected. So I don't think it will grow in proportion to the growth in advances.
The mix between investments and advances are changing. That is one of the reasons, and the CD ratio.
Okay, got it. Thank you so much. That's it from my side.
Thank you. Reminder to all the participants to ask a question. You may please press star and 1 on your touchtone telephone. Participants, if you have a question, please press star and 1. The next question is from the line of Anuja from Elara Capital. Please go ahead.
Hello, sir. Congratulations on good set of numbers. I just have one question. At the moment, CD ratio is almost 87%. What is the comfortable level of this? And can you give some guidance on deposit growth? I understand that we are trying to build quality deposit franchises, but is there any quantitative guidance for this?
So guidance is very simple, that if you have to grow faster, it's the answer lies in the question that if you are at a CD ratio of 87%, and if you want to grow faster than the industry on the credit growth, we have no choice but to build a deposit franchise better than what we have done in the last few quarters. I mean, we don't have a choice, and hence we are fully focused on that. And when we say deposit franchise, it's basically growing liability, because we also have to be cognizant of the LCR has to be between 100 to 120% or somewhere there. So given that perspective, granular deposit growth, NRI focus, generally NRI has for the ecosystem has come down a little bit for various reasons which you all know, but we expect that to reverse at some point of time, and that will give us some growth. Also, there is no substitute to execution, in deposit or liability franchise. So adding more customers, building task franchise. Also, we are looking at government businesses and things like that. % LCR we will continue to focus. So from that perspective, I think it's all execution. On the comfort level, and we don't have a choice. We have to build a liability. Okay. Now coming to comfort, I think overall the system CD ratio must have gone up significantly this quarter. I mean, it's automatic because if there's a credit growth of 18-19% and if liquidity is where it is today, CD ratio has to be much higher, especially among the private sector banks who are growing faster. So given that perspective, 87% is reasonably comfortable in my view on a relative basis. But anything above 90, we need to be monitoring it a little more carefully. And obviously, we don't want to. We are not an NBFC. We are a bank, so we will not depend on CDs and things like that to build. But if we have to dip into that once in a while on some tactical stuff, we'll do it. But that's not the strategy. We'll build up a very clear granular liability franchise, and we have people with us who have built granular liability franchise in one of the largest banks, who knows how to build it. Our head of retail, he was actually in the liability sales franchise in HDFC Bank many years back. So it's all, and we have seen that time also. It's all about execution. So let me put it this way: we have clearly focused on building granular liability franchise because doing assets is easy. And the core strength of a bank is the liability franchise. We all understand that, so we'll build that.
Understood, sir. Sir, and if time permits, I would like to add one more question. At the moment, NIMs are 5.6, which is not sustainable as you mentioned in your commentary. Earlier, we used to give guidance of 4.5 to 5% for NIMs.
Yeah.
Do we stick to same guidance or are we revising it to upward?
It's a difficult question. I'll tell you why. I mean, just because I've given a guidance and if I have ability to do more, why should I say no? Okay. But to be very frank, when I said that 4.5 to 5, I was talking about our slightly longer term kind of because if you have to have a sustainable growth on the with a mix, the mix which I said by 2030 or by 2027, where we'll be there, automatically the NIMs will come down. Typically, the way it works, you know that even if NIMs comes down, your ROA won't go down because ROA will be based on customer level profitability. So, and if you do not, for example, if you don't have a home loans with a customer, if you don't have a payment products with a customer, your liability franchise will also not go up. It's a cycle, right? You have to rotate the money through his liability and assets and EMIs and payments and ecosystem, etc. So to that extent, we have to start looking at, once we have all the products and processes, and it's still 3-4 years away, and that was the guidance that 4.5 to 5 is that time, then we will get customer level profitability and our ROA through, by that time we should be having our non-interest income to total income close to 13%, and I mean somewhere between 10 to 15%, and our customer level profitability has to significantly go up. Cross-sell ratio has to significantly go up at customer level, which today is very low. So NIM is not the only way to create ROA, but when you are running a niche franchise, that's the only way. But long run, when you have a 4.5 to 5, there will be many other income streams that will come along, including transaction banking, wholesale, and so on and so forth. In the medium term, I think if you look at the next 12 months or so, I think we should be able to maintain between 5 to 5.5. But I don't think that NIM is the only judgment of a franchise. Sometimes 4.5 or to 5 is better than 5 to 5.5, depending on how we look at the overall franchise.
Understood. That's it from my side. Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Pritul Shah from Anubhuti Advisors. Please go ahead.
Yeah, sir. In last call, you guided that for the full year, we are going to open 100 more branches. And if we see in current 6 months, there are 5 branches which have been opened. So is that guidance still remaining the same for the full year?
Yeah. We should be able to give and take 5-10 here and there because of some last minute execution issues, etc. We should be able to open around 100 branches this year as well. It typically happens in the last 2 quarters, and more it happens in the last quarter. That's the way it works for us. So we will be able to do somewhere close to 90 to 100 branches this year also.
Okay, got it. Thank you.
We have to give you more granularity on that. We have already identified 80 locations where work is on. Okay.
Okay. Thank you so much. That is helpful.
Thank you.
Thank you.
Ladies and gentlemen, this was the last question for today. I now hand the conference over to the management for the closing comments. Over to you, sir.
Thank you. Thank you, Manish and Axis Capital for organizing this call. And again, I wish to thank everybody for joining us on this Q2 FY23 call of CSB. And wish everybody a very, very happy Diwali, a long weekend ahead. And I'm sure a lot of you are taking Tuesday also as a holiday. So have a wonderful 5-day long weekend. Thank you very much and have a very, very good festive season.
Thank you.
Thank you, members of the management. Ladies and gentlemen, on behalf of Axis Capital, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.
Thank you very much.